What would you do if you owed $20 trillion? Or worse yet, what if you owe $20 trillion and on top of that, your real estate investments don't make enough money for you to repay that debt? That's exactly what's happening to the banking sector. And today, we're going to take a deep dive to understand what's happening and how all of that affects you. So we have an article here from CNN Business, and it talks about Wall Street being worried about another regional banking crisis. And as we go through the article, we see that Wall Street is experiencing a case of deja vu. It's been nearly a year since the collapse of 3 U.S. regional lenders that left financial institutions and regulators scrambling to prevent the spread of a banking crisis. And today, investors are worried they're back on a familiar territory. So for those who have been following us for quite some time, you will remember that about a year ago, we created a couple of episodes that talked about the collapse of a Silicon Valley Bank and some other smaller regional banks. And so it's been exactly 1 year now. And Wall Street is basically afraid that a situation like that might repeat itself. Now, back to the article. But while the last crisis was all about interest rate risk, this one, meaning the one this year, revolves around the $20 trillion commercial real estate market. What's happening? Well, after decades of growth bolstered by low interest rates and easy credit, commercial real estate has hit a wall. Office and retail property valuations have been falling since the pandemic changed where people live and work and how they shop. I think it's safe to assume that most of us remember what happened during the pandemic. A lot of the people who used to reside in big cities started migrating out of the big cities for many reasons. One, they didn't want to be surrounded with all that noise as to what was happening, especially if they didn't really have to stay within the city, because now with the opportunity to telecommute, or meaning work from home, a lot of people had the liberty to move basically anywhere. So a lot of people took the opportunity and moved to places with a better climate or places where they can get more space. And so that means that the commercial real estate space started declining, meaning office buildings were losing their tenants. Same thing with residential buildings. Those apartment buildings started losing tenants as well. So for those who didn't know, commercial real estate is evaluated based on the cash flow that it can generate, meaning the more money they can generate through rental revenue, that revenue is used on the calculation of the value of those buildings. So what this article is saying is that the office and retail properties valuation have been falling exactly because of that. People have been changing their ways to live, work, and shop. Less and less people are living in apartment buildings, and less and less offices are needed. And as if that wasn't bad enough, the Fed's effort to fight inflation by raising interest rates have also hurt the credit-dependent industry. And that's pretty bad for regional banks. So according to what we see here in the article, U.S. banks hold about $2.7 trillion in commercial real estate loans. And the majority of that, about 80%, according to Goldman Sachs economists, is held by smaller regional banks, the ones that the U.S. government hasn't classified too big to fail. Much of that debt, it's about to mature, and in a troubled market, regional banks might have problems collecting on those loans. More than $2.2 trillion will come due between now and at the end of 2027. So what does it mean, really? So this is what it really means. So let's say you bought a house, right? And this house, usually you will buy it at a fixed mortgage. And that fixed mortgage will probably go for about 30 years, right? So during 30 years, you will pay a fixed amount, meaning an amount that doesn't change. And typically with the payment, you are paying back principal plus interest. And depending on your mortgage setup, that could also include escrow. Most likely, escrow will be included. And what is escrow? Well, it covers your insurance payment and property taxes. However, the way things work with commercial real estate is actually very different. So let's say you come in here and you invested in a building. So we have a bunch of windows in here. Excuse my drawing. And let's say you come in and you decided to sign on a commercial loan. So commercial loans are typically interest only, meaning that when you take out a loan, you will only pay back an interest and the interest rates are typically variable. So the mortgages are usually ARM mortgages, meaning adjustable rate mortgages. And those type of mortgages are usually shorter in time, usually about 5 years long. So in the span of 5 years, you go from month 0 all the way to month 60, right? Why 60? Well, 12 months times 5 equals 60. You'll be paying interest on the first month, then you pay interest on the second month, and so on. And all the way towards payment 60, you will pay interest plus the principal, meaning all of the money back. So that's one thing, right? To help you better understand what's truly going on, now let's move on to this example. So let's say you came in and you bought this building in 2019 and you secure a commercial loan, let's say 4.5%, right? A very low rate. Then you fast forward a couple of years, and then in 2023, the Fed decided that, inflation is too high, that interest rates need to be raised. So then interest went from 5%, then they raised it again to 6%, then they raised it again to 7%, and so on, right? And so what will happen to the mortgage payment? Because it's interest only, that means that you are not reducing the principal. So let's say in this example that a building was paying $10,000 a month on mortgage payment, interest only. And let's assume that the building was generating rental income totaling $15,000. This is after all other expenses, right? And then when you take that $10,000 out, that means that the building was generating a profit of $5,000 a month, right? So what happened is that as the rates keep going up, that monthly payment also goes up. So let's say, for example, here it goes up to $15,000. Then over here it goes up to, $16,000. These numbers are just arbitrary. And then at 7%, now that number is at $17,000. So if the building used to generate $15,000 with full occupancy, imagine what will happen to the revenue if the occupancy starts falling down. So let's say the building has lost some of its tenants and now it's making $10,000 a month, right? So at $10,000 a month, meaning they're making less money, and then you're subtracting their mortgage payment, which happened to go up to $17,000. Now that building is operating at a loss of $7,000 a month. And that's just 1 month. So imagine what will happen month after month after month after month. Eventually, that investor is going to default. Now, one might say, well, that's that investor's problem. I don't have any commercial real estate. That shouldn't be an issue for me. But let me stop you right there. It's not that simple. Remember that everything is interconnected. So this affects more than just the real estate itself or the banks that provided those loans. Remember that, when one building doesn't do good, guess what's going to happen? It's going to create a ripple effect around you. So businesses around the area might start suffering, and that means less revenue for them as well. Or let's say you don't have any businesses as well, but then you rely on some of those regional banks. And let's say you do have a business and you are thinking about applying for a loan. Could be for inventory, could be for the expansion of your business. But because these regional banks are not collecting on those commercial loans, that means they don't really have enough money in their portfolio to loan out that money to you, the business owner, who might be needing that additional money to invest back into the business. So it goes beyond than just a simple real estate and what could be happening to the investor who happened to buy that building. So now that we understand how commercial loans work, let's continue with the article. So fears were exacerbated last week when New York Community Bank Corp reported a surprise loss of $252 million last quarter compared to a $172 million profit in the fourth quarter of 2022. The company also reported $552 million in loan losses, a significant increase from $62 million the prior quarter. And the increase was driven partly by expected losses on commercial real estate loans. Shares of the bank plummeted nearly 20% over the past 5 trading sessions and fell an additional 11.2% on Tuesday morning. And the U.S. Regional Bank Index dropped about 5.2% over the same period. And the problems don't just end here in the U.S. This is a global issue. And as you can see in the article, fear is also spreading overseas because Japan Aozora Bank said last week that banks alone tied to U.S. offices were partly to blame for its projected annual loss of 28 billion yen. That's the equivalent of $190 million last year. Remember that investors are global. Not just people in the U.S. get to invest in U.S. real estate. People from all over the world come and park their money in this country because it's considered safe, right? It's relatively stable compared to other countries. And the problem is not in Japan only. We see that Germany's biggest lender, Deutsche Bank, said that it had allocated 123 million euros. That's the equivalent of $133 million during the last quarter to absorb potential defaults on its U.S. commercial real estate loans. And that's more than quadruple the amount it set aside during the same 3-month period in 2022. But not all is bad news, at least for some, because some other companies are taking advantage of the situation to get a great real estate at a bargain. Remember what I said earlier about how the rental revenue is what defines the value of commercial real estate? So here's what's happening. Some companies are even selling off their once valuable properties for bargain bin prices. The Canadian Public Pension Investment Board recently sold a 29% stake on an office block in Midtown Manhattan to Boston Properties for just $1. Yes, you're reading that right, just $1. And the pension fund had invested $71 million in the building. As one of my mentors said, it is better to sell when you don't need the money than to sell when you need it. Because once you're in a precarious situation, everyone takes advantage. As losses from a commercial real estate loan portfolio accumulate, they can spill over into the broader financial system. Sales of financially distressed property can reduce market values of nearby properties, just like I mentioned earlier, and that can lead to a broader downward CRE valuation spiral and even reduce municipalities' property tax revenues. So once again, the problem goes beyond a simple building or a simple bank. It's all interconnected. It can affect you as a business owner. It can also affect all of the business around the area. And as you can see, it can affect municipalities because if the government cannot collect on property taxes, guess what's going to happen with the neighborhood? And everything else is going to start decaying. What would you do if you were in this situation? Would you even get into this much debt in the first place? Let me know down in the comment section and I'll see you in the next video. Bye-bye.